Hello friends, in today's video we are talking about the LOMA 280 module 2. In earlier parts we have already covered the LOMA overview and as well as module 1. So module 2 is individual life insurance, in which we have three chapters. One is term insurance, other is cash value life insurance, and the last one is supplemental benefit. So in the term life insurance, we need to cover the personal need, business needs, and the term life insurance. So now we'll start with the personal need. When we have the personal need, let's suppose an example. If a person is die due to any circumstances, and the family suffers serious problems like rent bill, food, cloth, and other necessities to survive. So these thing is required if a dependent person is died. So what insurance will do, if that particular person have a term life insurance, once he died he will get some amount of money, and that money a family can utilize to survive the rest of life. Then coming to the business needs also like in the same contrast. For example, if there is a business run by an individual or a group of individual, if that particular person is dies, so if they have a term life insurance, so they can pay the remaining dues whatever that person have. So it will help in running the business smoothly. Now we'll come to the important part, that is the term life insurance, in which we will cover three topics. One is characteristic of term life insurance and plans of term life insurance coverage, features of term life insurance policies. So first is, what are the characteristic of term life insurance product? Okay, so in this there are basically three types of characteristic. One is the death benefit, and the second one is the term life insurance policy does not accumulate cash value, and that particular term insurance is for specific term. So these are the three characteristic of term life insurance policies. If we talk about the plans of term life insurance coverage, so there are three type of term life insurance plan. One is the level term, the second is decreasing term, and the last one is increasing term. So level term is nothing but in which like initial premium and the annual premium will remain the same, and the death benefit, it will remain the same throughout the policy. If you have taken the coverage of $1,000, let's suppose $1,000, so that death benefit will remain the same throughout your policy coverage. The second is the decreasing term. So for the decreasing term, the best example is mortgage life insurance or credit life insurance. So when you take the home loan, so you will purchase the mortgage life insurance policy. So once you pay the loan, the your principal amount and principal amount will be reducing year by year. So so we'll understand from here only, like it will provide the death benefit decreasing over the policy term. Once the policy term is decreasing, the death amount also will be decreasing, because the home loan, whatever you are paying, it will be decreasing throughout your period of like term when you are paying the home loan premium. And coming to the increasing term, so increasing term is where the death benefit like over the term of the policy will increasing. Like in the first year it is $1,000, in the second year it is $1,100, like that it will be increasing. So that is the increasing term insurance. So we have understood the three plan in term life insurance. One is level premium, level term, decreasing term, and the increasing term. Now we'll come to the uh, futures features of term life insurance policy. So basically there are three features of term life insurance policy, and first one is the we can say it as return of premium, ROP. Means if you are paying the premium for a specific term, for example for 20 years, you have accumulated 1,000, you totally paid $1,000 premium. So once your term insurance is expired, you will get your premium back in return of premium policies. Second one is convertible term insurance. So term insurance have the uh, particular features like we can convert it to cash value life insurance, that is universal life insurance or whole life insurance policy. So that we can do. So that is the second feature of term life insurance policy. Third one is the renewable term insurance policies. So every year or how you pay the premium, your term insurance policy is renewing without presenting any evidence of insurability. So this is part of the future of term life insurance policy. We have covered all those three things in the term life insurance. Now we'll come to the next chapter. The next chapter is the cash value life insurance and endowment insurance. So in this we need to cover the whole life insurance, universal life insurance, and other three insurance, that is variable life insurance, variable universal life insurance, and the last but not least endowment insurance. So we'll start with the universal life. We'll start with the whole life insurance. Whole life insurance is basically, we can understand from the term only, it is for the whole life of a particular person. So if you have taken the whole life insurance policy, then it will cover your unless you died, the coverage will be there, and it have life cover throughout the life at a level premium. And the second option also is available in this, that is the cash value element, that is the saving element. So two benefits is there. So it is covering your life throughout the life, and it also have the cash value element. So that particular cash value element will help you in taking the policy loan and cash surrender value. If you surrender the policy, you can surrender it and you will get some amount of money. Then coming to the uh, premium payment period. So in the whole life insurance policy, premium payment period. So premium period, generally we have continuous premium payment period and limited, and the last one is single premium. So single premium is nothing but you can pay a single amount of money in the beginning and you will enjoy the coverage throughout your life. Limited premium policies, like example of paid up policies, you need to pay the premium for some particular term, 5 years, 10 years or 15 years, based on your convenience. You can decide and whatever the option is present for that particular policy. And the continuous one means you are paying, yeah, your coverage is for until you died, so you will paying your premium until you died. So that is the continuous um, premium payment period. Now we'll come to the modified whole life insurance. So modified whole life insurance is basically, we can divide it in two parts. One is the modified premium and the modified coverage. So we have two benefit. Modified premium, we can modify the premium for whole life insurance policy, as well as we can modify the coverage of that particular whole life insurance policy. Now we'll come to the whole life insurance covering more than one insured. So that is obvious. We have joint whole life policy in which more than one person is covered. So it is of two type. Means the joint life whole insurance policy is of two types. First category is first to die. For example, if there is two person insured in the whole life insurance policy and the first person is died, then the that particular policy benefit amount will be paid to the second or the nominee person. And then the second one is the last survivor uh, policy. So in that, if both the person is died, then only that policy benefit amount will be given. So we have covered the whole life insurance policy. Now we'll come to the universal life insurance. So universal life insurance policy, it basically contains three primary element. Three primary element. One is the flexible face amount. Flexible face amount. Second one is the death amount, and the third one is the premium. So these are the three uh, primary policy element of the universal life insurance. If we talk about the um, what we can say, index universal life policy, so these things we are not covering right now in the video. If you want to read these things, you can contact us, we'll provide you the PDF. So how you can contact, you can send us a mail or you can comment on the video, we can provide you the PDF of the LOMA 280. Now, now we are coming to the indexed universal life insurance. So, indexed universal life insurance is basically have the same feature as universal life insurance, but additional to it, it having the like index based saving element. So, you have two accounts in the index universal life insurance. One is the fixed account, and the second one is the index account. So fixed account, it will give you the like some fixed amount of interest on your saving element, whatever it will be accumulated as part of your premium. And the index account, how the index is behaving, so based on that your amount also will be changing. Now we'll come to the variable life insurance. So variable life insurance is basically in which premium are fixed, but death benefits may vary. So in variable life insurance policy, you have an option like in which premium will be remain the same, but death benefit will be vary. And now we'll come to the variable universal life insurance. So variable universal life insurance in which premium and death benefits both are flexible. You can choose as per your convenience. And the last one is the endowment insurance. So endowment insurance in which we have death benefit as well as maturity benefit. So that is the endowment insurance policy. Now we came to our last chapter, that is a supplemental benefit. So this chapter also we are not covering in more detail. You can read it from LOMA 280 PDF if you want. So we can go like as an overview. Supplemental disability benefit. So in this we have waiver of premium of disability benefit, waiver of premium of payer benefit, the disability income benefit. So this is all about like once you suffer the disability, and so you have the option of the waiver of premium. So that is the supplemental benefit in the disability. And the same thing is accident benefit. So once anything is happened to you due to the accident, then you have the accident death benefit. So an extra amount will be given if you died due to the accident. So like that these benefits will be there. And the accelerated death benefit. So there are three categories they have defined. One is the terminal illness benefit. If you have illness due to the terminal diseases, so you will get the benefit. The dread disease benefit, long-term care insurance benefit. Now benefit of additional insured. So in this we have three parts: spouse insurance rider, children insurance rider, and second insured rider. And the last one is insurability benefit. So in this we have two things: guaranteed insurability benefit, and the last one is paid up additions option benefit. So these things you can cover from the LOMA 280 PDF, and if you don't have, please contact us, we'll provide you. So thank you everyone. If you like this video, please subscribe our channel. Thank you.